We've got a very interesting question coming onto the show today from a gentleman called Brett from New South Wales, who's recently started his own self-managed super fund, and he's looking for a little bit of direction, just a starting point of what he should be doing, whether he needs to focus on cash flow or growth, whether he needs to look at commercial or residential. If you've got a question, click the link below and ask your question, and you could be appearing on this show, and we'll hopefully get you to the answer that you need. I'm Iannuzzelli, and this is what school should have taught you. Now let's get straight into the show.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you, so you can build the life you want.
Thank you very much for tuning in to What School Should Have Taught You. Today we've got a very valuable listener on the line. His name's Brett from New South Wales, and he's got some fantastic questions that he wants to ask, and these are things that I as an accountant get all the time. And our aim is to get Brett to where he needs to be so he can start making some solid decisions for his future. So I will welcome Brett onto the show and in the studio. Brett, thank you very much for coming online.
No worries.
Mate, you've got some very valuable questions to ask today around the self-managed super fund space. So for the purpose of our listeners today, if you would like to ask your question and we can get straight into getting you where you need to be, mate.
Yes, well, it's mainly around strategies with leveraging in property inside super. I'm just recently set up the self-managed super fund, and I'm umming and ahhing around going commercial or residential, wanting to get an idea of more the tax and the ins and outs on which is more viable. Just running the numbers, it's sort of making me question it, especially with the different, what the strategy should be.
Yeah, lovely, mate. Well, I'm going to ask some questions today just to build a bit more of a platform. So how much have you started your self-managed super fund with, mate, from a range perspective in terms of cash in the bank account?
So it's combined between me and my partner. Mm-hmm. We're at 260,000.
260K, beautiful. So it's a really good starting point. I obviously advise all my clients that, look, don't like to be involved or assisting in an establishment of a super fund if you've got less than 250, because it really takes away the potential quality of the assets that you can buy. You can start supers with less, you can start them with a lot more. You can have partial super funds and partial industry funds or retail funds. So there's no one rule around it. And getting a really good statement of advice or some structured planning from a financial planner sometimes is a really good idea, because it opens your eyes, Brett, and anyone listening, it opens your eyes to really what other assets that are out there. Brett, roughly what are the contributions that go into your fund on a yearly basis between you and your lovely wife, mate?
For me, it's been very sporadic. As I work for myself, so I sort of only contribute what I can forward sort of towards the end of the year, but going forward it'll be sort of work on that 400 a week, so that 20 to 25k a year sort of thing for me.
Yep.
My partner's on a pretty good wicket because she's with the ATO, and she gets 15.4%, so whatever that works out on about 90k.
Not bad at all. So she's probably putting in anywhere between 14 to 15 grand a year, which is fantastic.
Yeah.
That's a fantastic amount of contributions that are going in, anywhere between 35 to 40 grand between yous, and that gives you a really good opportunity to be able to sustain the costs of managing the investments within inside the fund, and alternatively work towards paying down the debt, which is fantastic. A super, I really love super as an accountant purely for two things. Number one, its nature around the asset protection, which is great. So if anything happens to you in the future with running your small business, they really can't come after your super, which is perfect. And number two, mate, it's one of the best environments for tax incentives. You get a 15% tax rate on any earnings or the contributions that go into your fund. So that means more of the money that you're generating or putting into super is staying in your superannuation's pocket, as opposed to going into taxes and other things. And alternatively, when you sell an investment and you've held it for longer than 12 months in super, whether it's self-managed or in big retail industry funds, the tax rate on those capital gains are only 10%.
Yeah, that's what I was, Yeah, that's what I was, my understanding as well, so.
And it's a big win. It's a huge win. So a lot of people, unfortunately, they really leave their super fund, the run of contributing into super, very late in life. And your goal is, if you can have a very steady stream now, and obviously in that last 10 to 15 years of employment, you want to be able to build up that super as much as you can, because we're ultimately all working for the plum or the cherry or the apple on the tree, which is at pension phase when we hit that retirement age or preservation age, we have an opportunity of converting the super fund into a tax-free status, which means any income that you're generating from that investment or investments, or you sell those investments and you want to put a large portion of it into cash, when it's in pension phase, it's all tax-free. So it's great to see that you're trying to contribute the most that you can personally, and obviously your lovely partner, she's getting a really good benefit through an increased amount of superannuation that goes in, being federally or government employed, which is brilliant. Mate, I'm going to ask a couple more questions. I suppose, what are you after? You after a bit more of the cash flow that comes from investing, or you after a bit more of the growth?
Definitely growth at this stage. Because I haven't really focused on it, mainly focused on investments outside of super. Now I'm sort of getting to that stage where I'm sort of hit myself really outside, and I want to focus on the growth inside of super. Also age-wise, I know it's sort of better now than later, and I'm working towards income, over the next sort of decade. As I'm tradie, so I'd like to be able to slow down eventually.
Yeah, mate.
And take it a bit easier, and the contributions mightn't be as high. If I do slow down a bit.
Yeah, work hard. All the tradies that are out there, we do appreciate all the hard work you do. It's a big day, mate, bending your back for 8 to 10 hours. So no, definitely understand where you're coming from. It's not something you want to be doing at 65 years of age. That's for sure.
No,
it's good to hear. So we've got really good contributions. We've got a starting point of 260. We've got contributions of anywhere between, say, 34 to 40 between years, and we probably want to focus on a bit more of a growth asset. Now, when we talk about leverage in super, obviously with leverage comes a bit more deposit that's required in super. Generally, anywhere between 20 to 30% is what we generally see. That needs to act as a contribution towards the asset. Now, interest rates in super, Brett, they are a little bit higher in super compared to, say, being outside super. Typically speaking, I see it anywhere between...
that's where the numbers sort of, what's making me question the asset type, with the interest rate there.
That 0.5% to potentially 1.5% difference to in super versus outside super as an interest rate is sometimes a difference of that property being able to be positively geared or negatively geared. The contributions that you've got going in, it's a healthy amount to work towards potentially paying down that debt. What I would probably advise more from an accounting perspective is that not necessarily would you pay down the debt, but rather you would want to try to find a bank facility or a banking product where it's got an offset account attached to it, because that will give you an opportunity, Brett, that you can build up the cash that you're saving through the contributions in the offset account of the particular investment that you're looking to buy. And by doing so, that will help reduce the amount of interest that you pay. In super, we can't extract equity out of super. So the banks, under the limited recourse borrowing arrangement, they don't allow you to actually go into the asset and extract the equity.
I know that,
Yeah, what many people do is they may save up enough capital through the contributions over the next couple of years to be able to act as a deposit for the next property. But I also have seen people do it very well, is that they've sold the property in super after a couple of years or a number of years of owning it, releasing that equity through the sale, which now means they've got a lot more cash. And because the taxing environment in super is it's so competitive in the sense that we're only paying 10% tax in nature on the capital gain that's made, what that means is you've got more capital to go towards more properties to then accelerate that growth or potential cash flow a little bit more.
And sorry, if it is negative to start off with, does that just get added, being in the super, I know it's not like outside of super, is that just added to the cost base, or how does that work, the negative side of things?
Mate, brilliant question, and probably not something that's asked often. If the property, for argument's sake, inside the super fund is negatively geared, Brett, it doesn't get added to the cost base. It actually forms as a deduction of the super fund, which then reduces the super fund tax that it needs to pay based upon the contributions that you're including into the fund. So let's say, for argument's sake, let's say, your superannuation contributions between both yourself and partner are 40 grand. In most circumstances, the tax on that would roughly be about $6,000. If you've got a property in super that is negatively geared by 10,000, then that 10,000 negative gearing will help offset the $40,000 of contributions that's going into the fund. You've now got 30 grand of net income that the fund is making, which is a combination of your $40,000 contribution less your $10,000 negative gearing. And the tax of 15% then gets calculated on the net income the fund is making, which in this particular case would be $30,000. So 15%
Right.
tax of 30 grand, you're looking at about $4,500 tax as opposed to $6,000 tax if you just had 40 grand of contributions going in with no further deductions or negative gearing.
Yep.
You can see, Brett, that within super, with the tax being so low at 15% on earnings, having that cash flow that you can derive, especially into the future towards retirement, is essential, because it's a great way to keep the fund moving forward, irrespective of what happens with growth or market conditions. And because the tax rate, again, being so low, it means more of the earnings that you're generating stays in the pocket of the super fund, which will eventually become in the pocket of you come retirement or pension phase. Combination, many clients, they like to focus on growth potentially inside super while they've got very strong contributions, because they don't necessarily need the money that the super fund's providing just yet. They're not at pension phase. They're very far away from it. They're happy to invest in assets where they can have growth superseding the level of potentially contributions that are going in. So again, yourself with really strong contributions between you and your partner, I don't disregard your growth prospects. I think it's actually probably a good thing. But sooner or later in life, as you start to get closer to pension phase, you do need to work out a way how you can convert that growth into more pension phase. Into more cash flow phase, I should say.
Cash flow, yeah.
Because I always say to people that Woolworths at the moment, or Coles, or if you go fill up your car at the petrol station, they don't necessarily accept your balance sheet just yet. They do want to have the cash going from your bank account to theirs. So it is important to make sure you get that pivot right. Now, typically speaking, and I'm not going to put a blanket over all investments, because I've seen many investments which are, cash flow orientated become very strong growth orientated investments, and vice versa. I've seen growth orientated investments over time become very cash flow dominated investments. But typically speaking, if we're just looking at off the back of the envelope, and we're looking at just the general terminology and the general consensus around the investments, commercial property, you generally do that because you're after a bit more of the cash flow. And after that cash flow starts to become stronger, you'll start to see that the growth will start to be there, because generally investors like to work on formulas. They're happy to pay to maybe obtain a 5 or a 6 or a 7% net yield. And typically speaking, if interest rates are a little bit higher and you're using a lot more leverage in the commercial property, you'll find that there may not be as strong a cash flow as you think, because the interest rates are slightly higher. Typically speaking, residential is where, most people will say that the growth prospects will be, because if you can find properties in very owner-occupied dominated areas, I suppose outside the investment space, you might find that someone who's willing to pay a lot of money because they love that location, they love the orientation of the block, they love that kitchen. If you've got enough contributions where you feel the decisions that you can make will outweigh, the potential negative gearing that may come from the lower amount of net rental income received from residential properties, and you feel there's a tremendous growth aspect there through your due diligence or through your, investigations, then going down the residential path is not an issue. You just need to make sure that your due diligence is being done, and that you've got enough cash flow from the contributions both yourself and your wife put into the fund to suffice any negative gearing. As I said, organically, you'll see that cash flow start to increase in that property as you start to build up savings in that offset account against the actual loan of the self-managed super fund. So cash flow can be brought into the fund through, some good decisions. At the same time, there's nothing wrong with if you want to go down the commercial path of purchasing a property. Again, you want to be looking at those properties where you might be able to have an X factor to increase that rental income. Because the quicker you can get that rental income increased, that net yield essentially, and it could be through the addition of a mezzanine, you could be finding a property with a bit more land content where you can add maybe an extra small warehouse to it.
So is that viable in super? Like, I know there's rules around not being able to alter certain things. You can do things like mezzanines and add.
Absolutely. On the condition that you do not borrow for the construction or the repairs and maintenance. So again, we can't extract any equity inside super. So if you've got enough cash balance in your super left after the deposit, and you've got an opportunity that you can use the cash to potentially build, say for argument's sake, a mezzanine, that could be a really good way to get a great return on your money. Now, again, you'll do all the due diligence, and you'll make sure that you go through all of the relevant applications and authorities that you need to go through to do it. But that could be a really good way to get a great return. I'll give you an example of a client of mine who done this in the residential space. They bought a property in the southwestern suburbs of Sydney in their super fund, Brett. At that particular stage, granny flats are only about $150,000 to build. I know the prices have gone up since the COVID pandemic period, but they made a decision that they had this $200,000 in the super fund, which was offsetting their loan, saving them at that stage roughly around about 6.5% interest. They made a decision to utilise that cash to build a granny flat on their property in the southwestern suburbs of Sydney. The reason they did that was they saw that on that $150,000, they could achieve over a 10% return on their granny flat. They were looking at the additional costs involved with the granny flat. So again, you have maybe a little bit of additional service charges from the council for the additional bins, maybe additional water connection, and a couple other minor things. But taking into account the net yield that they were receiving, they were going to receive a net yield of 8% on that granny flat.
And what about subdivision? Is that, I've heard that you can't do that with inside super. Is that because you're actually changing the property, like the actual property type, or is that a mistruth?
Yeah, no. There's an element of truth to that. So again, if you own the property outright, you can subdivide, of course, not a problem. But when you're in a loan with the bank, especially under limited recourse borrowing arrangement, which is the way that we borrow money from the banks, the bank holds a security and they hold the title. So really, you really want to be doing, your subdivisions inside super if you've got an opportunity to do it when you've got no loan on the property, because you are complicating and muddying the waters significantly when you've got lending. Because the bank has an issue is that, well, we've lent you money against that particular title. You're now subdividing and that title value may be very different. That's it. So it becomes a very tricky process, and hence I always say to my clients, Brett, that you always want to do things very vanilla inside super fund. It is your money. It's for the money for your retirement, for your pension, and you don't want to get too cute, because if you start to muddy the waters too much, because it gets audited and it's got a SIS Act that it needs to comply with, it becomes very tricky to make sure you're following all the rules.
Yeah, that's the thing, just getting the strategy right from the start and then just working towards it.
Absolutely. And what you also need to consider as well, Brett, is you can have the benefit of both cash flow and growth. And it doesn't mean that you have to invest all your money into super. That's all your money into one asset in your super. It's a misconception out there that, if you started up a self-managed super fund, you buy shares or you buy property. You can actually do both. And I see that in many, many super funds that we do the compliance for, is that they might have, for argument's sake, a negative geared residential property where there's really good growth aspects. And then they really pigeon pair that and match it with some really good stocks where they believe there's a strong cash flow and an assurity and security of that stock value. So that's something that you can also review, and vice versa. If you want to go down the cash flow path and use commercial property as a means to do it, there's nothing stopping you from looking at some stocks or ETFs or managed funds where there's a really good growth aspect to it. At least that way you've got your hand in two pots, and it's going to help you make the decision of which way you want to go. What I would do in your particular situation to arm yourself with the right knowledge, and it's going to give you the basis for you creating your strategy, is it's worthwhile for you to actually sit down with three really good professionals. A really good financial planner who can assess maybe some equities for you and have an opportunity to look at some growth or potentially some cash flow equities. If you're going to go down the commercial property path, maybe have a chat with a commercial property buyer's agent and give you some understanding of some recent deals where they've had some growth and some cash flow prospects attached to it. And at the same time, potentially a residential buyer's agent with the same thesis.
That's where I've sort of been tossing up to. So I feel like there's opportunity in commercial at the higher price point, and that's why I was more leaning towards residential. And maybe if I can get some good growth over the start of it, and then transition into commercial later.
And if there's some good growth that you can get from anything that you buy, again, equities or property, and you sell it, remember, if you've sold it after 12 months of ownership, it's a 10% capital gain tax. Where I've seen some really, really good investors do it quite well, and I'll share with you another example in a war story, is a client of mine established a self-managed super fund back in 2010, so just post the GFC. They had enough money at that stage to buy two cheaper properties, and this time it was in the northern parts of New South Wales around the Central Coast. Those particular properties, they held them for about 10 years, believe it or not, 2020. Both properties doubled in value off the back of COVID boom, and we had a really good price increase, especially in New South Wales from about 2010 all the way through, even including all the way through to the Banking Royal Commission. What they did do, Brett, is they sold those two properties. they made about close to about $600,000 or $700,000 in net capital gain. They paid the tax on that $600,000-700,000, so about $60,000-70,000 tax. Yep. All of a sudden, with the contributions that they had been putting in the fund, the original balance plus the profit after tax, they had over $1 million in super.
Yeah, right.
And the majority of that $1 million in super did not come from their initial deposit nor their contributions. It came from the $600,000-700,000 they made. With that money, what they did do is they then used that $1 million in super to buy 3 properties, 2 commercial properties and 1 residential. That is an opportunity that they had, and that could be a great opportunity for you to, to counter into over time, as long as you get your asset selection right at the start. But there's no right or wrong answer. You've got to do all your due diligence. I think getting a mortgage broker involved quite early as well, Brett's important, because you need to understand the rules of the game. And the rules of the game is how much you can actually borrow and how much the contributions between you and your wife can service. That will dictate to you your maximum borrowing capacity inside super. And with that maximum borrowing capacity inside super now being provided, it will give you clarification of you being able to buy really good assets, such as good commercial or potentially good residential. So I think if you get those professionals around you really honed in, what it's going to give you is more content, more information, more knowledge, more education to be able to make the right decision, whether you pivot into commercial property later on, you start off with commercial property or residential, you maybe diversify and have some really good equities inside your fund as well. And if you can have your financial planner, your mortgage broker, your accountant, and your property professionals all working around you in their own lanes, providing you the right education, mate, you're on your way to having a very successful retirement and hopefully retiring a bit early.
Hopefully. Or at least slow down.
At least slow down. That's right. Mate, are there any questions I suppose you would like me to answer? Because I feel like I haven't given you the investment that you're going to buy, but hopefully with that giving you a couple of different ways that you can achieve what you want to get to. But are there any questions I can help you with in aid of our listeners today?
No, a lot of the questions that I had you sort of answered throughout the discussion, so you've done well. Definitely around the subdivision and also I didn't realise the way the negative gearing works inside of super. That cleared things up for me, definitely.
And mate, I think if you can continue to contribute, again, financial circumstances taken into account, if you can continue to contribute more in your name into super and again maybe more in your wife's name into super, it's not going to go astray because there are some substantial tax benefits involved depending on your own marginal tax rate, where adding more money into super might be a pretty good investment return, not because of anything else other than the tax savings. It's important now with the new superannuation concessional threshold going up to $30,000, we can contribute $30,000 of concessional contributions into super. So it does go up. It has gone up from 25 to 27.5 and now 30. So incrementally every year, hopefully it will continue to rise and we can get more money into super.
That was the idea, sort of set it at $400 per week, and then if I have a good year, I can sort of top it up towards the end of the year sort of thing.
I understand why you've gone into super. You want to keep your investment and your borrowing journey alive. Tapping out in your own name, it's a really good way to push forward with your journey. Again, making sure that you do all your due diligence, you speak to the right professionals to get the right answers, get that lay of the land with the broker to get a maximum borrowing capacity, I suppose, scenario being drawn up. So then it's going to give you an opportunity whether you can go into a really good quality asset to start with. Keep it quite vanilla. Have a look at maybe an offset account if you don't want to invest in equities. If you do want to invest in equities, make sure that you are really speaking with the right professional to get the right level of equity investment in there, whether it's growth or cash flow orientated. Capital security is always important. Don't treat your super as something that I can't touch until I'm 67. This is a very important entity for you to do the best that you can possibly do. And by doing the best that you possibly can do, you're putting in a very tax incentivized environment, especially later on down the line when it's all tax free, setting you up for that steady stream of income well into your retirement years. Brett, it's been an absolute pleasure to have you on. I really want to thank you, and we do appreciate you asking this question because it's something that a lot of people ask me as an accountant, and I think it's really just getting people the knowledge, the understanding of where they need to start, giving them some things that maybe they haven't thought about, and then giving you some direction and some action points to go into and speak to the right people to get it done.
No worries. Thanks for your wisdom today.
Brett, absolute pleasure, mate. Have a lovely week, and thank you for asking your question and joining the show.
Yeah, great. Thank you.